I'm talking today with Daniel Moore from Investors Mutual. He's speaking about the process that the company follows in managing investors' money, including asset selection, portfolio turnover, and how they identify quality companies at the right price. Daniel, thanks for your time today.
Thanks, Glenn. Thanks for having me.
Now, Daniel, firstly, within the Australian equity space that you cover, can you just talk us through your process here?
Yeah, sure. Really, our process is around two key things, which is quality and value. So as you can imagine, we're trying to buy the best quality companies we can at the best prices we can. And I guess really it means two questions. Well, what's quality and what's value? So for us, quality is really around three key things, which is a company has to have a strong competitive advantage. So it normally means they're the number one or two player in their industry for a reason that's sustainable. So it normally means they have a very low cost position in the industry, or they might have some level of intellectual property in the industry, which is sustainable and means they can earn above average margins and returns in that industry, which is sustainable through the long term. We also like to invest in companies that have a strong recurring earning stream. In terms of value, it's quite a subjective thing. To us, value doesn't necessarily mean low PEs. I think this is a big misconception to many people in the market. For us, low valuation is where the earnings multiple is low relative to the quality of the business. So for a company like CSL that trades on quite a high multiple, that might not necessarily be expensive if the quality of the business is incredibly high. So we have to marry up the quality of the business relative to, say, the market and the valuation relative to the market. And we make this assessment when determining if a stock is good value.
And in terms of portfolio turnover, how often do you change the companies that you hold? And have you actually changed your cash allocation in recent times?
Yeah, sure. We take a very long-term view. I mean, a lot of people say that, but honestly at IML we do. So our turnover is 20%, in some cases less than some of our funds. So the average holding period is about 5 years. Some companies we've held for much longer. And so I guess it comes down to when you make that initial purchase of an investment, you are really doing a lot of research into the long-term prospects of a company. So you don't get spooked by something that happens in the short term. Our cash levels are very high at the moment, roughly 9% of a maximum of 10. We are finding it difficult to buy good quality companies at good valuations. So we're patiently waiting for that opportunity to occur. And we're starting to see a few things already this year with long bonds, interest rates starting to move up. You're getting some quality stocks like Transurban get sold off quite aggressively, which we'll start to look at.
And Daniel, can you talk us through the Investors Mutual process in identifying underappreciated companies?
It's really case by case. It's not, I guess you can get sectors that can get unappreciated as a whole, and then you get stocks, individual stocks can be unappreciated as well. On a sector basis, I guess a good example is if interest rates were to rise substantially, you can get more interest rate sensitive sectors getting sold off quite aggressively. And sometimes the sector might get sold off too much and there's quite a basket of opportunities. The other situation we look for unappreciated companies is more on a case-by-case basis. And normally that's because something's gone wrong in the short term. And I guess this is sort of the advantage we try to take advantage of being a long-term investor is the market is very short-term, incredibly short-term. The focus on quarterly earnings and quarterly sales, sometimes monthly data from economic indicators. We tend to look through that, and we tend to try and look through the noise and really assess the long-term prospects of a company. So quite often we'll see share prices down 20% in quite a short period of time, a matter of weeks or months. And we really sort of ask ourselves each time, is that valid? Have the actual long-term prospects of the business changed that much? Has the value of this business really changed 20+%? So that's sort of what we do. We try to look through the short term and try and keep a very long-term view and take advantage of those short-term movements.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.